There is momentum in the economy. In fact, we are now 1 quarter in the new financial year, and even high-frequency indicators are telling us that the economy is carrying on the momentum that we have seen until the end of March 2024, when we grew at 8.2%. So the average growth rate in the last 3 years up to March 24 has been around 8%, and as we write in the survey, real GDP is 20% above the pre-pandemic levels. And the growth has been contributed to by a steady maintenance of the share of private consumption. Capital formation is beginning to recover as we would expect post-COVID and post-balance sheet repair. And exports are doing quite well under the circumstances as well. Of course, some of you might say this adds up to more than 100, but that is to remind you of the fact that it is not subtracting imports here. So otherwise, this is not net, it is not net exports, it's only exports, so it's a gross number. And investment is being driven by not only by public sector capital formation. Both union and state governments have clearly been spearheading the capital formation. But let me also tell you that private capex has been growing. Private capex has recovered. After the stagnation or decline we saw in 1920 and 2021, they did pick up in 21-22 and 22-23. Of course, some of you might go into the granular details available and say that private capex formation picked up strongly in the dwellings aspect and not in the machinery and equipment and intellectual property products. But even that, post-COVID. So because if you look at the national income data, you can see the breakdown of private capital formation into these three components: dwellings, machinery and equipment, IP products, etc., intellectual property products. The recovery is beginning to come through in the latter two areas also, which is what exactly will be driving higher quality jobs. And household savings in physical assets has improved, and we have written enough about it. Households are not in distress. Households actually are investing in financial assets, which have done very well. Especially in the last 4 years, the foray of retail investors into stock markets through systematic investment plans, through mutual fund investments, has been quite prolifically documented. And our national income data do not record these at market prices. And that is the reason why there is a feeling that financial liabilities have grown faster than financial assets of households. But financial assets of households are not marked to market. So households are doing quite well in the aggregate. And if you also see the default statistics of small ticket loans, etc., they do not flag any signs of distress, and I have also written about them in occasional columns, etc.